Welcome everyone to today's webinar called How to Avoid Business Failure. And today's webinar is brought to you by SV Partners, and today I have Darren Vardy with me. Okay, some information about Business Propel. Business Propel is the next evolution in business assessment tools, offering end-to-end view. This tool will shape your business for success. Leaving no stone unturned, the ecosystem will help you assess and refine your current methods to ensure your business is operating and performing in an optimal fashion. Make faster and better decisions to grow your business with the use of our experts that we call our Business Propel Professionals. My name is Philip Paresis, and I'm the Digital Marketing and Community Manager for Business Propel. Remember, everyone, if you have any problems, have any questions, on the right-hand side, you have the ability to chat, ask questions, and make sure you respond to our polls when they come up, and we'll be having a poll in just a second. So we have business diagnostic tools on Business Propel. So if you're not sure how your business is performing, you can always do the Business Propel Performance Diagnostic. Through the Business Propel Performance Diagnostic, your raw income and expense figures are transformed into financial ratios, which can then be used to provide financial assessment of your business. Okay, so that report is actually free, and you can do it at any time after this webinar. I highly recommend that you log into businesspropel.com.au and try that report out. And we have our first poll question, and the first poll question is, do you measure your pricing against your cost to ensure a profitable operational margin? So if you have a look to your right-hand side, you'll see a poll just coming up right now. So we'll give it a second and wait for the poll results to come through. We've got a couple yeses coming through, which is great. All right, perfect. So so far we have all yeses, which is great. 4 yeses so far, and growing very quickly to the yes, which is a great sign. Hopefully this webinar, or for the guys that really want to say no but maybe too shy out there, don't forget you can chat to Darren and SV Partners for free 30 minutes after this webinar. We'll supply all the details to how to contact Darren and the team. So please don't hesitate to do that after the webinar, of course. And let's move forward. Okay. Today I have Darren with me. Darren, welcome.
Thank you, Phil.
Excellent. So Darren's the director of SV Partners, and you're going to take it from here, mate.
Thank you, Phil. Good afternoon, everybody. Darren Vardy is my name from SV Partners. A little bit about my background. Other than being a CPA and a registered liquidator, I've worked in the insolvency and turnaround space for a little under 30 years. So having been and having seen a number of businesses in different industries, I thought it'd be worth talking to you today about 3 key areas. Firstly, the SV Partners Commercial Risk Outlook Report. Then moving on to signs of deteriorating solvency. And then thirdly, the final new regime known as Safe Harbour. So a little bit about SV Partners. We're a specialist accounting and expert advisory firm focused on supporting professionals and their clients. We have offices throughout New South Wales, Queensland, Victoria, and Western Australia, focusing on regional areas as well as having presence in the major cities. Our services include insolvency, turnaround, forensics and advisory. And we also have a few associated businesses, being SV Strategic Solutions, which is a provider of business improvement strategies, Biz Diligence, which provides business valuation and due diligence expertise, as well as Smart Fee, which is a fee funding solution provider to professionals. So moving on to our commercial risk report. To assist in the provision of our services, it's important to understand the current business environment and the economic outlook of a region and or an industry. As such, we've developed this commercial risk outlook report that is published on a 6-monthly basis, which provides an analysis of the current state of Australian businesses from an insolvency and prognostic perspective based upon commercial risk data. The report also expands on the drivers behind commercial risks and the impacts for business owners. And as you can see there, a copy of our report can be found on our website.
And the report's free.
And the report can be downloaded. Yes,
Great.
It is free. So when we look at the businesses from a commercial risk point of view, there are effectively 3 key categories. High to severe, which are those businesses which fall within risk bands 1 to 3. Average to moderate, which are those businesses which fall within risk bands 4 and 5. And minimal to low risk, which are those businesses that fall within the risk bands 6 to 8. So what effectively this means is that for those businesses within the high to severe risk band, stabilisation action is required. The chances of successfully bringing a business out of its distressed position is generally low, unless there are only 1 or 2 specific issues that need to be addressed and there is sufficient time frame to execute the required stabilisation strategies. For those businesses in the average to moderate risk band, business improvement action is generally required to ensure that they do not slip into a more severe risk band than they're currently in, but also to enable them to position themselves for growth. And as for those in the low to minimal risk band, businesses need to look at opportunities to further enhance their operational efficiencies, which is generally done through technological advancements, or to develop strategies to grow into new markets, both from a product and a geographical basis. So looking at those businesses on a national basis in the high to severe risk band, 2.4% of all businesses within Australia fit within that band. In the moderate to average risk band, there's 22% of businesses. And in the low to minimal risk band, we have 75.6% of businesses. Now, what does that all mean? When we compare the March 2018 results as against the August 2017 results, we've seen a reduction in the number or percentage of businesses in the high to severe risk band from 2.6 down to 2.4%. Likewise, there's been a reduction in those businesses in the average to moderate risk band from 22.6% down to 22%. And as you would expect, you can see an increase in that minimal to low risk band from 74.8% up to 75.6%. So in effect, there has been an improvement in the business environment with evidence of decreasing levels of risk and more businesses moving from the higher risk bands to the lower risk bands. So looking at the national analysis on an industry basis, here we can see that in terms of the number of businesses at risk, construction has the highest number of businesses at risk. But as a percentage of the total businesses within an industry, accommodation and food services is number 1 at 6.4%. And on a national basis, we can see that retail trade, transport and postal and warehousing, together with arts and recreational services, are rounding out the top 5 industries most at risk nationally. Here we have a slide which actually provides the comparison of the number of businesses at risk across all industries as at March 2017, August 2017, and March 2018. This illustrates that the majority of industries experienced reduced overall risk during the last 6 months. But as you can see, there are a few industries that experienced an increased overall risk, that being education and training, information, media and telecommunications, and agriculture, forestry and fishing. So looking at the eastern states, overall Tasmania has the highest portion of businesses within the high to severe risk category at 5.7%, followed by Queensland at 2.8% and New South Wales at 2.7%. So moving on to New South Wales. By way of an overview, New South Wales continues to be the largest state economy and accounts for approximately 1/3 of the nation's economic output. Here we can see there's 2.7% in the high to severe risk category, 22.6% in the moderate to average risk category, and 74.7% in the low to minimal risk category. Now, it is noted that we have higher percentage of businesses in the high to severe and average to moderate risk bands than the Australian national average percentages. Now, this is not a surprise given the current state of the New South Wales economy and associated activity, together with the sheer number of businesses that exist in New South Wales as compared to the other states. But quite often we see that where there is a booming economy, strains are placed on working capital and cash flow of businesses to keep up with that activity. And generally that's where we will find that there will be some businesses which are more at risk than others. So in comparing the results from March 2018 to August 2017, it's not all doom and gloom. We can actually see, akin to the national statistics, there has been an improvement across all categories and an improvement in the business environment. So looking at the industries, not dissimilar to the national results, we can see here, in terms of the number of businesses at risk, construction has the highest number of businesses at risk. But as a percentage of the total businesses within an industry, again, food and accommodation services is number one at 7.3%.
And why do you think that is, Darren?
What we've seen, Phil, is that in respect to food and accommodation service industry, there's been a real movement or transition from the formal sit-down dining to a more casual style of eating out, with the focus of consumers being on quality of product and price. Mm-hmm. There's been a number of small cafe-style venues that have popped up, and they're impacting the larger traditional restaurant style of operation. And given that we know that a major cost in the traditional style of operation is the space that these businesses occupy, i.e. rent, and the space, the competition from operators with a lower cost-based model is having a significant effect on the more traditional model of dining.
Okay, that's interesting, because you see little pop-up cafes and shops and little things keep popping up everywhere. So
you do, and look, by way of an example, just recently there's been the closure of an Outback Jack's franchise in Wollongong. Now, one of the major impacts on that is that business was in Crown Street Mall, taking up primary space. Now, one of the impacts that's occurred down there is that on a Thursday every week, the council has introduced food markets, which occupy Crown Street Mall, mm-hmm. from about 5 o'clock through to about 8 o'clock of an evening. So while people are coming into Crown Street Mall, they're not actually dining in the restaurants that are there. they're availing themselves to the casual dining opportunity of the markets that's provided, which is having a significant impact on the existing businesses.
Which will be really small, cheap rent. It's probably once a week.
Correct.
Yeah.
Correct. So it's these sorts of things, and unfortunately with these types of businesses, it's very hard to adapt and change, particularly when you're tied into such a fixed price or cost by way of rent.
Mm-hmm. Yeah, of course.
So as you can see, to round out the top 5 industries in New South Wales, we also have retail trade, other services, and arts and recreation services. So when we look at the majority of industries here for New South Wales, we can see that again, industries have experienced a reduction in the overall risk during the last 6 months. However, it's interesting to note that, and different from the national statistics, that wholesale trade, agriculture, forestry and fishing, and mining have actually experienced an increased overall risk in New South Wales. So when looking at New South Wales, this slide looks at the top 3 high-risk regions, comparing the results from our last 3 commercial risk reports. And the top 3 regions are Sydney Southwest, what's known as Sydney Inner Southwest, and the Parramatta region. Now, you'll note that in the 6-month period to August 2017, there was a significant deterioration in these regions. However, it's evident that during the last 6 months, there has been a rebound. And this has resulted primarily from the increase in infrastructure works throughout these regions and a general improvement in the economic conditions, together with an increase in business confidence in key industries such as retail and construction. However, it should be noted that in the recent National Australia Bank monthly business survey, published in March 2018, there has actually been a significant decline in business cash flow during that 6-month period. And together with a restriction in borrowing conditions for businesses, we expect to see that that impact will be felt over the coming months, and the results of same will come out in our August 2018 commercial risk report. So people out there might be asking, what makes up the business risk score? Now, we can't disclose where we get our data from. However, what we can say is that the risk score is made up of a number of factors, which include the type and frequency of credit inquiries, the existence and the time on change of the business registration, any credit activities, including adverse information of the business proprietor or owner, any existing default information, a trade history of payments, any serious adverse events such as external administration of particular entities within the industries, and director information and credit activity of a company's director.
So this risk score is gathered by SV partners, and it's a framework you guys use?
It's data which is accumulated, which we obtain, and then we're able to then extract from that key data the relevant information, which gives us the various businesses within the various categories. Yes.
Great.
So moving on to signs of deteriorating insolvency. probably important to understand exactly what insolvency means. And that is really a term that is described for a person or a company, its inability to pay its debts as and when they fall due. There are effectively two pieces of legislation which covers both personal and corporate insolvency, that being the Bankruptcy Act and the Corporations Act. And the Corporations Act defines solvency as a person is solvent if and only if the person is able to pay all the debts as and when they became due and payable. A person is not solvent, is insolvent. And the Bankruptcy Act includes that same definition. So what are the tests of insolvency? There are two primary tests: the cash flow or commercial insolvency test and the balance sheet test or the absolute insolvency test. Now, under the cash flow test, a person or a company is generally regarded as insolvent where there is insufficient cash or other realizable resources available to pay all creditors at various times as they demand. Now, under the balance sheet test, a person or a company is insolvent if the total liabilities outweigh the value of assets available. Therefore, there is insufficient assets to discharge those liabilities. Now, it is actually possible that a business might be commercially insolvent and fail a cash flow test, but there might be sufficient assets to satisfy the balance sheet test.
So that could mean that they have enough product to sell out there. They have machinery, cars, etc. Is that we considered assets, or is that just
correct?
Yeah.
So there may be sufficient fixed assets, and you often hear the phrase "asset rich, cash flow poor."
Mm-hmm.
Yeah, and quite often we'll find that there may be some fixed assets. Could be plant and equipment, could be land,
Mm-hmm.
So on and so forth. That if those assets were realised, they would be able to be used. That money would be able to be used to actually pay all the creditors.
Mm-hmm. Okay.
But some of that plant equipment, or maybe say land generally isn't income producing.
Yeah.
But what you have to pay with land is rates. You have to pay land tax. So if the business or the entity or the person owns land and is not producing any income, how do they pay those related costs on a cash flow basis along the way?
So there's restrictions to some of the assets.
There can be, yes. So from a liquidator's perspective, when we look for insolvency, we look at the thing called the current ratio. And that is the key in determining whether a company is able to pay its debts as and when it will fall due at any point in time. So if the current ratio is less than 1, the company is unable to pay its debts, therefore it's insolvent. So moving forward and looking at some trends that business owners should be monitoring. When looking at the cash flow statements, declining revenues, increasing cost of sales relative to revenue, declining gross margin or gross profit, increasing expenses or overhead costs relative to revenue, and obviously, declining net profits.
And of course, this will work with any size business.
Correct. And when we look at the balance sheet, deteriorating working capital position, increasing receivables and payables balances. And that's not only an increase in the size of or the value of monies owing to you or you owe to others. It's also the aging of them. When your receivables start blowing out and your payables, for that matter, start blowing out from 30 to 60 days or from 60 days to 90 days. That's a bit of a sign that there's some cash flow issues there. Decreasing cash and increasing borrowings. Increasing inventory balances. Quite often we find that, when the sales are not there, the stock piles up.
It also means storing that inventory too sometimes,
Correct.
right?
Yeah. And then there's the additional cost of storage and not being able to turn the stock over that comes into play. Increasing intangible asset balances. Quite often we find that this miraculous figure of goodwill will appear in a balance sheet. But the question's got to be asked, is there any value to that goodwill? And the answer to that generally is, if a business has traded over the last 3 years at a loss, it's highly likely that there is no real value of goodwill in the trading business. There may be other components within the business that attracts goodwill, yes, but on a pure trading perspective, it's unlikely that any goodwill will actually exist when the company has traded at a loss for some time.
Interested to hear that when you have all these startups that haven't made a cent in the last 5 years and valuated for $40 billion sometimes.
Correct. So and look, there may well be a strategic goodwill, and it may well be that the value of the business is worth to someone else the opportunity cost of setting up themselves.
Yeah.
And that's where there will be a strategic goodwill. But purely on a trading basis, there would be very little goodwill. And also, decreasing net assets, equity, the bottom line. And when we look at the cash flow statement, decreasing net cash inflows, decreasing cash from operating activities, decreasing cash used in investment activities. And we always talk about there still needs to be a reserve to reinvest in the business. If you're unable to reinvest in your business, quite often we find that the cash is being used elsewhere, and the question needs to be asked, why is it being used elsewhere? Because you need to maintain the minimum. And also increase cash used in financing activities. And that simply comes down to borrowing more, therefore having to pay more for that finance. So, what are some typical warning signs? Lack of business control. Now, whether that be at a strategic level, a management level, or an operational level. Unless there is control over the business, there are certainly risks there and a warning sign of insolvency. Overdue taxes. Quite often, when we're appointed as administrator or liquidators of companies, there's a tax debt. Now, the tax office is generally the only creditor who doesn't knock on the door wanting payment. They're not suppliers of product that rely on continued trade. And where a lot of businesses go wrong is quite often the tax debt is not hidden, is actually hidden in the balance sheet, not necessarily in the accounts payable, which a lot of people monitor day to day and week to week.
So it can sneak up on them.
So it can quite easily sneak up on, and it's for people not provisioning the amount that needs to be paid on a regular basis and looking at the numbers on a regular basis to ensure that they've got that covered. Spoke about this earlier, continuing losses. Poor relationships with banks or lenders. And, we spoke about earlier how the NAB report showed that borrowing is becoming harder and harder. So if businesses don't have access to funds, well, then what we find is that that will restrict their activity.
And the current Royal Commission will probably make things a little bit more harder again.
The feedback we're getting from a number of brokers, finance brokers, is that that's exactly right. Yeah. Particularly with the major four. And in fact, there was an article this morning in My Business magazine in respect to the activities of Bank West foreclosing on businesses. which came out of the Royal Commission inquiries into the Commonwealth Bank.
Wow.
And its activities. Inability to raise equity or finance. The majority of small businesses, SMEs in Australia, are financed through mortgage lending.
Wow.
Out of the owner's personal property.
Personal risk to family.
Personal risk to family.
Yeah.
If you've borrowed the maximum against the property for which your serviceability will enable you to, from the profits that you're earning out of the business, some businesses won't be able to go back to the well, so to speak. So they might not be able to raise further equity or finance from the traditional sources upon which they relied on historically.
So basically, it seems like business might be looking at like other services, brokerage services like hashing or Prosper.
Correct.
Things like that. Yeah.
Correct. Which then all come generally at a cost.
Yeah.
Suppliers demanding COD. Quite often when businesses get into a cash flow difficulties, their suppliers will put a hold on their account and demand that they pay cash on delivery for a certain period of time.
It makes sense. They're trying to manage their cash flow.
Correct.
Their inventory.
Correct. A common one, banks requesting additional security. Quite often, a bank to lend more money might request security over, say, an investment property that the owners may have, if they've already got security over their personal home. We've actually seen and have a situation at the moment where mum and dad agreed to guaranteeing a loan of son and daughter's business. And in doing that, the bank came back and said, well, we just don't want a guarantee. We actually now want a mortgage over your home to extend further.
Wow. So
it's not only putting the owners, but the actual family unit at risk.
Do you think these restrictions might be stopping a bit of innovation or people starting businesses?
It certainly dampens entrepreneurialism. Absolutely. Your court notices, your letters of demand, if they start turning up, certainly a warning sign for insolvency. And my favourite, the inability to produce accurate, and I should say timely, financial information.
Which is a scary one. You think people running businesses with money coming in, inventory going out, staff pay as you go, GST, everything that they probably don't have. Some people don't even have systems to actually tell them what's going on.
Correct. Now, I'm certainly of the view, if you had asked me this question 5 years ago, I would have given business owners a little bit of slack, so to speak. But now with the way accounting systems operate, the automation, the majority of accounting systems out there are now cloud-based. There is no excuse for a business owner, in my view, not to have the financial information readily available at their fingertips.
There's no excuses.
No excuses. If they don't, it's because they haven't spent the time to enable that to be. And at the end of the day, things in a business change rapidly. You need to be able to assess the impact of those changes, minor or major. And if you don't have your financial information up to date and readily available, there is no way you're going to be able to impact or determine the impact of an event or a situation. And it might simply be that you want to expand into a new market. Now, what we often find is that expansion of a business can drain working capital, can drain cash. And we've seen a number of businesses fall into insolvency as a result of expansion because they had not determined what the cash flow hole was going to be and how they're going to address that cash flow hole. They've just sought to expand thinking, she'll be right.
Yeah.
And quite often that's not the case.
Yeah, to be honest, I've experienced it in like family businesses, for example. You get one a large customer that has needs to service all of Australia, and all of a sudden, from producing 1,000 units a week, you have to produce like 40,000 units a week. And of course, you're going to say yes to the business,
Yes.
And then you have to figure out how you're going to produce those 40,000, transport and everything else. And all of a sudden, you're looking like you're getting a loan from the bank for another 500,000 just to make this thing work, right?
Correct. And particularly where you're in an industry where it's high volume, low margin. And sometimes the bank won't give you money. There are other mezzanine lenders out there that can advance you funds against your sales, your debtors. But that comes at an additional cost. And at some point in time, you've got to weigh up that additional cost to see whether actually that is eating away at your profit or in fact wiping your profit out entirely.
So what you might think is an advantage to spread your brand or your products around Australia, China, around the world, could be doing you an injustice, basically.
Correct. Yeah. Correct. And what I guess the way I like to explain it is this, and having done a fair bit of work in the construction industry, if I'm constructing a building for $1 million with a 10% profit, I'd rather be doing that than constructing a building for $10 million with a 1% profit. Reason being is that I may be looking to make the same dollar profit, net profit of $100,000. But that bigger building is going to be 10 times more complex, therefore at least 10 times more risky in me actually earning that $100,000.
More things can go wrong.
Correct.
Yeah.
So sometimes, and we see that in construction industry all the time, where some businesses chase the contract price, but don't necessarily factor in, well, what is my real margin and what can go wrong, and mitigate and look to mitigate the risk of doing that type of business.
Yeah, good analogy.
Okay, so moving on to the various insolvency options. There are a number of different types of appointments that can be had, both corporate and personal.
Yeah, this looks very complex. How would a small business actually work through this?
And look, it is. Whilst it is complex, what businesses need to be aware is that there are a number of different options available for the different circumstances that are presented. Not every business is the same. Every business is unique. And that's where, it's important for businesses to remember that if they think they might be trading insolvent, or they're likely to be trading insolvent in the future, or they've got a cash flow issue that they need to deal with, or whatever the issue may be within their business, it's important to reach out to a professional to obtain the appropriate advice for the circumstances that they're presented with.
Of course, they can contact you.
Absolutely. Yep, they can. And look, these insolvency options are that. They're an option. Quite often we're presented with circumstances where an insolvency appointment may not necessarily be required. And that's where our strategic solutions brand fits in, to look at what the issue is, see if we can't work through the issue without the necessity of needing to go down that insolvency route.
So there's a period where basically you don't have to go down insolvency. You guys can strategize coming earlier rather than later in the piece to actually put a strategy in place to possibly get them out of a mess.
Correct. And quite often the majority of good businesses that we come across, it's the old saying, if only we were there 6 months earlier.
Yeah.
Or 12 months earlier. And quite often people and business owners will realise they've got a problem, then try and work out that problem themselves. That's why you have experts, and that's why you have professionals, is to seek advice early to avoid an adverse situation later down the track.
Good advice.
And I guess just a bit of a segue from that is that, recently we've had the government enact the new safe harbour regime. Now, for those who don't know, what safe harbour is all about is to try and strike the balance between protection of creditors and encouraging directors to be innovative and take greater reasonable risks within business. And the whole aim of the safe harbour regime is actually to avoid the formal insolvency process. And there are a number of reasons why you may want to avoid the formal insolvency process. And some of those reasons may result around the fact that there may be certain contracts or certain agreements that automatically terminate when a company is placed into. So therefore, that goodwill that we spoke about earlier, when it comes to business, there may be some very good contracts which form part of a business's goodwill. But as soon as an insolvency appointment occurs, those contracts automatically terminate, therefore wiping out any goodwill that actually may exist. So the government sort of brought in this, what they call their safe harbour regime. It's not a formal appointment. I've got to say that. It is certainly not a formal appointment. And what it also doesn't do is it also doesn't eliminate any exposure for the director for any insolvent trading. But what it does do is it limits the exposure for insolvent trading from a point in time forward.
Okay.
Now, in saying that, the whole idea of safe harbour, as we indicated, is that the government believes that it'll lead to an increase in private business investment because directors will take more risk and be more entrepreneurial, which again will lead to, retained employment, wage growth resulting in same, flowing down to the households and increasing in consumer spending, which then in turn they hope will see an increase in the Australian GDP. But to meet the safe harbour requirement, there are a few criteria that needs to be met. And the criteria that needs to be met is, firstly, there needs to be a recovery plan developed. And the recovery plan needs to set out what is going to happen and how that is likely to lead to a better outcome for the company and its creditors than a formal insolvency appointment. And it may be simply that a plan is to make the business market ready for sale as a going concern, which will provide a better return to creditors than if the company was placed into liquidation and its assets sold off at auction. Mm-hmm. It may be as simple as that, because there may be some value in those contracts, as we discussed, or those agreements that could be realised, but for the company entering external administration or liquidation.
And this is something you suggest people have in place, or this is the minimum they need when they're going to the safe harbour?
This is the minimum they need. So they need to sit down and say, yes, I've got a problem.
Yeah.
How am I going to get myself out of the problem? Because by trying to get myself out of the problem will limit and hopefully minimise any exposure I have to, as a director, to insolvent trading. Mm-hmm. Obviously, we've employee entitlements need to be provided for in accordance with the Corporations Act. Now, for those who aren't fully aware, employees have a priority over ordinary unsecured creditors, including the tax office, for their entitlements, and that being superannuation, annual leave, long service leave, and so on.
Look after your people first, basically.
Correct. And look after the very people that are helping you do the business. Ato reporting compliance. Quite often, when businesses don't have the cash flow to pay the ATO, the PAYG or the GST, they stop reporting. They stop lodging their BAS returns. They stop lodging their IAS returns. So it's important that if you don't have the cash to pay the tax, at a very minimum, you need to continue with your lodgement program and ensure that all your lodgements are up to date, but also ensure not only your BAS, your quarterly or monthly, whatever it may be, your BAS and your IAS lodgements, but also your end of financial year tax return lodgements. And then as part of the recovery program, adequate books and records need to be maintained so you can show what you've done, why you've done it, and how you've ended up with a better outcome than what the alternative is. And so this is all very new. This was only enacted on the 19th of September 2017. Albeit, discussions first came out in January 2010. So this has been on the cards with the Turnbull government for some time. We do think it will be of benefit to business. There's a school of thought that it may not necessarily really be taken up or utilised by SMEs, particularly when it comes to the reporting compliance requirements, given that the majority of businesses that we see from an insolvency perspective don't have their records up to date. But as I said, and I go back, there's no excuse why they shouldn't. If someone wants to avail themselves of this regime, that's the criteria. So I guess the key takeaways from today is, be alert to the signs of deteriorating insolvency and the warning signs of insolvency. Seek early professional advice to avoid the consequences of insolvent trading. And whether that be advice on how to turn the business around or to use the safe harbour regime, whatever that may be. Early advice means a better opportunity or possibility of being able to avoid a business trading whilst being insolvent, and take action. Quite often, and we've seen it in the past, as professionals, we can give all the best advice in the world, but unless the person receiving the advice, the business owner, is willing to have a change of mindset and take proactive action to rectify a situation, the buck effectively stops with the business owner.
You can imagine they're probably proud, set up the business, could be a family business, etc. So last thing they want to go out and basically say is, I need help.
Yeah, and a lot of that is, and unfortunately, and it's sad to say, but sometimes, people need to be able to admit failure to then move on. And failure happens. And in that regard, what I say to business owners is that they're not the first and they won't be the last.
Yeah, very good point.
So I guess just a reminder for our audience, our commercial risk report is available from the SV Partners website. The report actually does also set out a number of geographical locations and breaks the data down further from the New South Wales basis. So, for instance, I look after our Sutherland Shire and Illawarra offices, and from that we service the Shoalhaven and the Southern Highlands. So there is risk data for those 4 geographical regions, as well as other regions around our 13 offices around Australia. And it doesn't matter whether you are actually located in one of those regions, but you might simply be doing business in that region.
Yeah.
So business owners need to be aware, well, if I'm going into a geographical region, what does the business risk profile of that region on an industry basis look like?
Because you can see, your suppliers, your customers might be there. So
correct.
Lose one large customer and your business might be at risk yourself. So it's not primarily that you're thinking about you have problems, but you might be able to foresee some regional problems coming up.
Correct.
In different industries anyway.
Yep.
So with Business Propel, we have a few more events coming up, and one's the ultimate cheat sheet on business planning for growth, a bit opposite about what we're talking about, but again, talking about capital or exit at the same time. And we have a partnership with Amazon Business Essential Days coming up. So that's for cloud adoption strategy and roadmap. So if you want to get your business on the cloud, please come to that event. That's a physical event. Please check out our events at businesspropel.com.au events. Darren, it's been a pleasure. Lots of information there, lots of insights. I'm actually going to go and download the report now to have a look through. As I mentioned, heaps of family business. A lot of my friends have their own businesses too, so it'll be interesting to see the sort of results. I'll send that through. Guys, on the webinar, of course, if you have any problems with your business, you're thinking you might be leading down a path that doesn't look good for you, remember, act now, right? The last action was take action, and I highly recommend that. And of course, you can talk to Darren, telephone number 9531-8365. His email is presented on this particular slide too. And of course, you can actually contact them inside Business Propel on consultants, SV partners, strategic solutions. I really appreciate your time. Thank you for sharing your lunch with us. And I've just pushed another poll as we go off for today. Thank you again, and I'll see you next time. Thanks very much.
Thank you, Phil.